It is now my pleasure to turn today's program over to our host, Mr. Brian Ward. Brian is a 27-year veteran of financial service industry. He has been with Legg Mason Global Asset Management for the last 2 decades. Brian is currently the head of the U.S. Specialty Sales. Without further delay, I'll be handing the call over to Mr. Brian Ward. Sir, please go ahead.
Thank you, Jay, and good afternoon, and certainly Happy New Year to everyone on this call. Again, this is Brian Ward, and I can't tell you how excited I am to be here today and welcome all of our attendees from around the globe who have tuned in, knowing that your time is valuable and your decisions are valuable. So for your decision to tune in today, we're very happy. With me, I am joined by our featured speaker, Jeff Schulze, investment strategist with ClearBridge Investments, our leading global equity manager with over $146 billion in AUM and a 50-plus year heritage. Now, not only is Jeff our speaker this afternoon, he is also the chief architect of the Anatomy of a Recession program and the Recession Risk Dashboard, which he will certainly touch on today. In addition, Jeff has been quite the road warrior, presenting AOR to our clients from main stages and or breakout sessions at national and regional meetings to the branch offices of all our partner firms. And it's because of this and the work of our sales teams and certainly all of you that I'm proud to highlight that in just under the 2 years that we've been talking about Anatomy of a Recession, it is now engaging with over 40,000 advisors, with nearly 19,000 of you subscribing to our monthly updates. And incidentally, if you're not a current subscriber, and some of you may not be, please visit our website at www.leggmason.com/AOR.com. Or call our sales desk or talk to any of the field sales folks that come into your branches daily. So again, thank you for your trusted partnership, the business that you've done with us over the years, the business that you might consider us for going forward, and certainly, and worth highlighting, the constructive feedback we continue to receive from you, which enables us to deliver value beyond just product. As far as this call goes, Jay touched on this, but I'll reiterate. We will have a number of polling questions throughout Jeff's talk. I think you have one in front of you right now that we'd love for you to participate in. It makes the calls more fun, and it actually helps inform, believe it or not, some of the comments that Jeff might make. There will also be time for Q&A. So as the questions come to you, as Jeff speaks, please enter them as quickly as you can into the queue so that we can address as many as possible. So with that, I'm just about to introduce Jeff Schulze. You know, Jeff, in 2019, and unlike 2018 in many respects, it was a wonderful year to be invested, irrespective of what you were invested in. If you look at things like the MSCI World Index being up 28%, led by U.S. equities up 31%, and right behind that with European equities up 27%, or even if you look at government bonds posting solid returns, it's been quite a year. So with that sort of high-level backdrop, things have felt pretty good of late. So whether this is the case a year from now, 6 months from now, or not, this is one reason that I personally love these January calls. I think they set the stage and the tone for the year ahead. They're very timely, and we hope you find the information very relevant. So with that, I'd love to turn the call over to Mr. Jeff Schulze. Jeff.
Great, Brian. Thank you, and good afternoon, everybody. Again, hope you had a safe and happy New Year. Glad you're able to join us here for the first quarter 2020 update, the first one officially of the new decade. And if this decade is even remotely close to as interesting as the last one that we came out of, I think we all are going to be surprised on the upside on what could be possible. Now, I know that I start every call off with this slide, and it may sound a little redundant, but the reason why I do this is I think it's the very foundation of why we put this program together. This idea about market crashes versus pullbacks. Now, I know there isn't a textbook definition for a market crash, but we like to think of one as a bear market that lasts longer than a year. Those deepest and longest drawdowns that scare people out of their asset allocations right when they should be buying. You can see since the early 1960s at the top left-hand side of the page that we've had 6 market crashes. 5 out of 6 of those coincided with a recession. Now, just to hammer home this point on how important it is to identify the crashes, we went back and we looked at the same 55-year period, and we took out every other large drawdown that may not have fit the technical definition of a market crash, and we've labeled those as pullbacks on the right-hand side. Now, importantly, when you compare the crashes versus the pullbacks, we come across three important conclusions. First, on the bottom left-hand side of the page, you can see that your average crash lasts 3.7 times longer than your average pullback. Your average crash lasts a little bit over a year and a half versus your average pullback at less than half a year. Secondly, in the middle of the page, your average crash sees a drawdown that's 2.3 times more severe. So in your average crash, the S&P 500 loses 42% versus 18% in a pullback. And then lastly, and most importantly, your average market crash is 2.9 times more likely to coincide with a recession. So the idea about market crashes and recessions is really the foundation of the program that we have today. And the reason we think recession risks have been rising over the course of this year, and at this point, we think the odds of a recession over the next year are 50%. And we're now going to be on slide 8 to focus on the recession risk dashboard that we have here at ClearBridge. Now, you can see there hasn't been much of a difference from an individual indicator standpoint from Q3 to Q4, but you still have 6 green, 3 yellows, and 3 red signals, but most importantly, the overall dashboard signal is a yellow, which means rising recession risks. Now, the one area that we've been focusing on is the consumer section. You can see out of all 4 of the consumer sections, all of them are green currently, and this is the one section that I'd like to see green because the consumer has been the workhorse of this entire economic cycle, and if you start to see some weakness with the consumer, it could mean that a recession is around the corner. Now, looking into the individual indicators, housing permits are up almost at 1.5 million per an annual rate. This has easily beat consensus in the last month that we saw, and I think this has been a very important transition from multifamily houses to single-family houses, really driving housing permit growth. And given where interest rates are and the fact that millennials are now moving into the housing market, and this is a dynamic that's been going on since 2016, I think that this continues for the next couple of years. The other one that I'll highlight is jobless claims. Now, jobless claims were creeping up in the fourth quarter of last year, and in the first week of December, jobless claims jumped up to 252,000 in a week. That was about a 40,000 jump. This was really concerning for us, but now with the benefit of hindsight, jobless claims have come back down to the lower end of the trading range that it's been at 210,000. Just as a reminder, jobless claims is the #1 indicator in our dashboard. It's usually the last indicator to turn red because when jobless claims increase on a year-over-year basis by 12%, you've always had a recession, and now the jobless claims again have fallen down. That means even if we do have a recession, it's likely not going to be over the next 3 or 6 months. But again, the consumer continues to be the focal point of the dashboard, and I think the key to whether or not this is a slow patch or a recession.
So, Jeff, let's pause for 1 second and talk about polling question number 1, a question that we tend to ask every quarter. So question 1, will the U.S. experience a recession in the next 12 months? Well, the answer is almost close to 100% no.
Wow.
We're looking at about a 90% no over a 10% yes. And if you look at this versus Q4 of last year, when we ran this call in October, the number was closer to 70-30, so quite an uptick.
Nothing like some bullish market action to get people more excited about the economy. I like that number. Well, the one thing I really want to talk about here is the difference between a red signal and a yellow signal. So in the dashboard's history, you can see here that we've had 8 red signals. 7 out of 8 of those ended up being recession. So it's a much more powerful signal. We've had several instances where the dashboard turned yellow, economic growth reaccelerated and went back to green. Those times were 1995, 1998, and then also 2016. Now, ultimately, I think all of those would have been a recession, but the Fed recognized weakness in the economy early. They cut rates and gave liquidity to financial markets, and the economy accelerated out of those slow patches. In 95 and 98, the Fed cut 3 times each for 75 basis points. And in 2016, although the Fed didn't cut rates, the market was pricing in 4 rate hikes that year, and the Fed ultimately only did 1 in December of 2016, which was the net effect of 75 basis points. So if you fast forward to where we are today, the Fed has clearly gotten the message. They've cut rates for a total of 3 times in 75 basis points, and they've beginning to expand their balance sheet, Whether you want to call it QE or not, they've expanded their balance sheet dramatically, and in just 9 short weeks, they reversed 8 months worth of quantitative tightening as we had the repo crisis. So the Fed has clearly gotten the message, and it's given us the opportunity for this to be a slow patch. Now, when you have a yellow signal, traditionally 6 to 9 months after that yellow signal, the economic growth, the economic data within the dashboard will either accelerate and go back to green or decelerate and go to a recessionary red. We turned yellow in July of 2019, which really makes the first quarter of this year the show me moment for this economic cycle. Now, moving forward a couple slides to slide 11, one area where I think investors have a misperception right now is the yield curve. Investors think that since the yield curve has uninverted, it means that we're out of the woods right now. But if you look at the last 3 recessions, the yield curve uninverted ahead of that recession each and every time of a range of from 1 month to 5 months to that recession, and the average steepness of the yield curve at the time of the recession was 67 basis points. So yes, the yield curve has uninverted. We're at around 40 basis points right now, but we're not ready to give the all clear signal just quite yet. Looking at it from a different perspective, if you look at it from when the yield curve first inverted, the recession averaged anywhere from 8 to 16 months in the last 3 recessions. Right now, we're only 6 months post the first inversion. More importantly, if you look at 1989 and then also 2006, the markets went up double digits in the year following that inversion before you ultimately had a recession. So yes, the yield curve is uninverted. I'm very happy to see that part of that uninversion is the long end of the curve, the 10-year Treasury going up. But I'm not ready to give the all clear signal yet until we probably get to the middle part of 2020. Now, one of the reasons why we felt that there was going to be a slowdown here in the first quarter or a soft patch was because the lagged effects of Fed tightening. Now, when the Fed tightens or cuts rates, it usually has about a 1-year lag time for that to hit the economy. And if you think about the Fed tightening that happened in 2018 and all of the balance sheet normalization that we saw last year, we think the maximum effect of Fed tightening will center in on the first quarter of 2020. And there has been more Fed tightening than meets the eye. Now, if you include the effects of quantitative easing and forward guidance, and we use the methodology that was put out by the Atlanta Fed, you can see that the shadow Fed funds rate, proxy for how much Fed tightening has gone on this cycle, has been closer to 600 basis points of tightening rather than the 250 basis points that you traditionally see with the Fed funds rate. This 600 basis points of tightening is more than what we've seen in the 4 previous tightening cycles going all the way back to the early 1980s. The one thing that I really want to point out here is the second bullet point, is that when you've had Fed tightening prior to a deceleration in manufacturing PMI, and as a reminder to everybody, manufacturing PMI does a very good job of capturing inflections of economic data and economic growth. For example, in this 10-year economic cycle, we've had several periods where economic growth has accelerated and decelerated. Manufacturing PMI captures those accelerations and decelerations very well. Now, when you've had Fed tightening prior to a deceleration of manufacturing PMI, on average, it's troughed at a 40.5 level, and I think this is one of the key reasons why manufacturing PMI continues to disappoint on the downside versus consensus expectations. The most forward-looking component of that survey is new orders, and that came in at a cycle low at 46.8. It's a long way of saying that we may not be out of the woods quite yet, which rhymes with what the dashboard is saying. Now, one thing that I could say that is affecting manufacturing PMI is the Boeing production disruption. Some estimates have that the manufacturing PMI would be a point or 2 higher if it weren't for that. But again, I think we're going to get clarity on this point as we move through the first quarter. Now, if you move forward to the next slide on slide 13, the market certainly is pricing in that this is a soft landing. But if you think about the market, it's a fickle beast. The market has predicted 19 out of the last 5 recessions, and as we talked about just a second ago, it failed to predict a recession in 1990 and 2007 following the yield curve inversions. So the chart that we're looking at here looks at the last number of times that we've had 3 rate cuts. 2 of those ended up in a soft landing, which is 1996 and 1998. 2 of them ended up in a recession, which was 2001 and 2007. Now, importantly, the 3 months following that 3rd rate cut, the markets were generally positive. They were positive 3 out of 4 of those instances. It's really only 6 months after that 3rd rate cut where you can tell whether or not we're going into a recession or a soft landing. A recession would signal that the equity markets are down substantially, and then the soft landings that we've had, the markets were positive generally speaking. So yes, the market is re-rated higher on a lot of liquidity from global central banks, and also the removal of some of the tail risks from trade wars and Brexit. But again, this all rhymes with the first quarter being the show me moment for this economic cycle. Now let's move forward to the bear case.
So before we do, let's get to polling question number 2. Which part of the Morningstar style box will do best in 2020? I believe you had upwards of 5 or 6 options. So the answer, all right, sorry guys, we were waiting on the answers. Oh wait,
Okay.
let Jeff go.
So let's move forward to the bear case, and this is going to be on slide 15. So the bear case really centered around trade wars, at least part of the bear case. The trade wars have hurt business confidence, and when the first tariffs went into effect in 2018, not coincidentally, you saw a peaking out of business confidence, and you also saw a peaking out of manufacturing PMI. Since then, both of them have been in a very large downward trajectory. The one thing that I'm concerned about is that business confidence continues to deteriorate. Businesses may resort to layoffs. They certainly resort to not hiring that marginal employee that they need and not doing CapEx. Now, this is one area that I think we got to watch very closely. And even if we do get a Phase 1 deal tomorrow, I don't believe a Phase 2 deal is likely going to happen anytime soon because the thornier issues of forced technology transfer and IP theft are likely going to take a much longer time to negotiate, which will happen after the election. But at least this takes off the uncertainty of further tariff hikes. The other reason why I think that business confidence may not rebound is the uncertainty created by the election cycle. Businesses may be reluctant to invest in CapEx or hire a marginal employee until they know the political environment that we're going to see in. But if you look at a number of the different confidence surveys out there, the NFIB survey, which is a small business survey, saw a pretty big jump month over month in December. The Duke CFO survey saw an inflection higher, but you still have yet to see the Business Roundtable survey turn around quite yet. And my hope is, I don't think we're going to get a huge rebound in business confidence, but hopefully a rebound or in business confidence to stop declining and maybe trough and move a little bit higher from here. But another reason why business confidence has been declining is slide 16. Profit margins have been under pressure. Now, we don't look at S&P 500 profit margins because those usually are the best companies in the world, so you'll see cracks in their foundation as you're actually entering into a recession. What we like to look at is NIPA profit margins. This looks at micro, small, mid, large, and mega cap companies, and it's a much better barometer of what's going on in the U.S. economy. Now, importantly, you saw a large downgrade of NIPA profit margins in July of this year, and it shows you that profit margins have been flat really since 2016, and it's disproportionately hurt your micro and small cap companies because of a tight labor market and because they have the inability to pass through tariffs to their consumers. Now, this is really important because if you look at the left-hand pie chart, 59% of Americans are employed by a company that has less than 1,000 employees. If you think of your average Russell 2000 company, they employ 3,679 workers, which is roughly 4 times the size of where most Americans work. Now, we're going to get a new NIPA profit margins number at the end of January, and I'm really hoping to see a rebound here. But if we don't get a rebound, NIPA profit margins is one of the variables that is on the borderline of being red. This is an area that we're watching very, very closely because if margins deteriorate, they will start to cut back hours on employees, and you're certainly seeing that in the manufacturing sector. But if that doesn't do the trick, they will resort to layoffs. And layoffs, again, is the last domino to fall as you enter into a recession. Now, the last piece of the bear case is slide 17, share buybacks. Now, corporations have been the largest buyers of equities by far and away during this cycle, and it's the central bank accommodation is the unsung hero of this if this equity bull market that we've had, its Robin to that Batman is going to be share buybacks. And you can see that corporations have done over $4 trillion worth of buybacks since the second quarter of 2019, far outpacing what you've seen in ETFs, and you've actually seen net outflows for pensions and households as well. Now, buybacks are expected to come down after 2018's lofty levels. We're expecting $710 billion worth of buybacks this year, but if you continue to see buyback erosion and we get below 600 or 500 billion next year, that means that the largest buyer of equities is leaving the marketplace, and that's going to be a key reason why you could see higher volatility, but also some downward pressure on equity markets generally speaking. And if you look at non-financial S&P 500 cash balances, they've declined by about 11% over the course of the last 12 months, which is the largest percentage decline since 1980. And a key reason for this is because the money that's coming back from overseas, better known as repatriation, is starting to slow. Out of the $1.7 trillion that was locked up abroad, $960 billion of it has already come back home, and a lot of that money that will remain overseas to fund overseas operations. Also, one thing that we're looking at very closely is the election. Believe it or not, since before 1982, share repurchases were considered a form of market manipulation, but in 1982, the SEC provided a safe harbor for companies buying back their own shares under Rule 10-B-18. Some of the candidates have been campaigning on changing the rules on share buybacks, and if that does happen after the election, again, that means that corporations, which have been the largest buyers of equities, could be moving to the sidelines, which could cause some downward pressure on equity markets. Now let's move over to the bull case. Now in the bull case, let me turn to slide 19. But before we do that, let me turn it back over to Brian really quickly.
So again, we asked you a poll we called number 2, which was essentially, in your opinion, which part of the Morningstar style box would do best in 2020? So as the numbers have come in, it looks like you believe large cap growth, number 1, with 30% of the vote, large cap value with 25% of the vote, large cap blend with 12%, and like a mid cap growth with 12%.
Well, that's a very healthy spread across the style boxes.
It is.
At the last slide, in slide 60, that I think that makes sense in the kind of the bear section is what parts of the style box do best when you see equity market drawdowns. This looks at all 5% plus drawdowns that we've had since 2005. We've had 24 of them. We're looking at it from 2 different perspectives. What was your average performance during that drawdown? And blue means that you were a better performer or you were more defensive. Red means that you were less defensive, and you can see that large cap blend and large cap growth were the most defensive areas of the style box. And then we also looked at it, what was your hit rate? How many times did you outperform during those 24 periods? And you can see that large cap blend at 83% was the highest, followed by large cap growth at 75%. The one thing I want to point out here is that the next closest hit rate for outperformance was small cap growth at 42%. So again, if this bearish thesis plays out, if we're going to have volatility, maybe some downward pressure on equity markets, large cap blend and large cap growth appear to be the areas that are going to give you the best risk-adjusted return and the smoothest ride for your clients. Now let's move back over to the bull case. We've explored the bear case pretty deeply. Let's move to the bull case, and I want to go to slide 19 to talk a little bit about the bull case. And coming into 2019, if you remember a year ago and you've been listening to these calls, ClearBridge was very, very bullish compared to consensus expectations. We were bullish because we found years that rhymed with what we saw in 2018. We saw years with robust earnings growth, a strong economy, PE multiples that came in, so you didn't have a great market, but most importantly, you had a solid green color emanating from the ClearBridge dashboard. Now, absent having a recession, the snapback year, which would have been 85 and 95, tended to see above average market returns, well above average market returns. And with the benefit of hindsight and going through this year, we actually think the 1994 through 1995 analogy makes the most sense to where we are today. Importantly, in 1995, in July of that year, you had a yellow overall dashboard signal. Yellow overall dashboard signal happened in 2019 as well. The Fed started a cutting cycle in the back half of each year, and you had very robust returns with 34% in 95 versus almost 29% in 2009. Now, if we continue moving down this path, this analogy that we've had with the 94-95 period, you can see that 1996 had a very strong price return in the S&P 500 of 20%. Now, consensus estimates are very bearish on what the market will return here in 2020. But again, this is just something that suggests that you may have some potential upside, more upside at least than consensus estimates have at the moment. Now, obviously, the soft landing case has to center on global central banks, and this is slide 20. You've seen a 180 in global central banks since the end of 2018. This follows the 33 major central banks that are out there. At the end of last year, 42% of them were hiking, 0% of them were cutting. You fast forward 11 months, now 0% of them are hiking, and 26% of them are cutting. More importantly, if you look at the three major central banks, which is the Fed, the Bank of Japan, and then also the ECB, which is the European Central Bank, those three central banks together on a monthly basis are doing over $100 billion worth of QE per month. So global central banks, when they're all rowing in the same direction, that can be a very strong force to not only help U.S. markets, but help global markets, generally speaking. Also, the reason why this may not be a recession is slide 21, that leverage doesn't look recessionary. Now, generally, when you lead up to a recession, you see bubbles form, and a lot of those bubbles come in through the misallocation of debt from either a household perspective or a corporate perspective. Now, if you look on the left-hand side of the chart, you can say that leading up to the last 7 recessions, the increase of debt between households and corporations has increased by 15% of GDP. Today, over the last 5 years, you've seen households delever, and even though corporations have brought on some leverage, the total increase of debt here has only been 2%, which is well above that 15% average. So this means if it's a recession, economically speaking, we think it's going to be a shallow one, all things considered. Now, if you move forward to the next slide, a couple slides forward on slide 24, this is a reason why we could have returns that are above what consensus expects right now, is that the average investor has not participated in the equity rally that we saw in 2019. And there's a pattern that's gone on several times during this cycle. And the pattern goes like this. In year one, you have a large drawdown. That large drawdown scares equity investors because they have memories of 2008 and 2001. So because of that drawdown, in year two, they pour a ton of money into bond and money market funds and they shun equities. After year two turns out to be a positive year in the markets, and the worst case scenario doesn't happen, in year three, investors get FOMO, or fear of missing out, and they pile back into equities, and you have a very strong equity return in year three. Now, if you follow the chart that we see here, year three in that first pattern happened in 2013 when investors filed into equities. Your total return then that year was 32.4%. The next cycle where that happened was 2017 was the next year three. Investors piled back into equities at 21.8%. And last year alone, investors put $868 billion into bond and money market funds. They took out $215 billion out of global equity funds. And the net difference between the two was $1.1 trillion, which is by far and away the largest move in financial market history. So if we don't have a recession this year, I do believe that FOMO will kick in. You're going to see investors move money out of money markets back into equities, and you could have a return profile that's much greater than consensus expectations. And right now, you have $3.6 trillion in money markets, which is the second largest ever in history, which is quite a bit of dry powder on the sideline to be able to put to work in financial markets. And just by looking at investor sentiment here, and this is a new section that we have in the deck, you can see equity speculators also remain on the sidelines. This looks at margin debt, and this is slide 52 for you guys dialing in on the phones. You can see that there's a very close correlation between margin debt and the S&P 500 since 1997. You see that huge divergence on the right-hand side with margin debt coming down and the S&P 500 continuing to rise. Again, if you have this FOMO and you don't have a recession, you have this soft landing, you will see a rise of margin debt, and generally speaking, that is accretive to the market. That's something that pushes markets continually higher. And the last thing I'll mention here before maybe I turn it back over to Brian is that consensus expectations are the lowest that we've seen in over 14 years. This is slide 51. Now, consensus is generally too optimistic when the cycle deteriorates. You saw this in 2000, 2001, 2002, which we haven't shown on the chart here, but you also saw it in 2007. So they're too optimistic when you're going into a recession, but also they're too pessimistic when the market rebounds. You saw this dynamic in 2003 and 2012, and the fact that consensus only expects 4% returns in the S&P 500 in the upcoming year, and this is the lowest since 2005. As a pure contrarian play, this is, generally speaking, in my opinion, a bullish omen for the market in the upcoming year. So, again, we're at a crossroads. The road on the left leads to a recession, and the ClearBridge Recession Risk Dashboard is flashing a yellow signal. The road on the right is signaling a soft landing. The markets are clearly pricing at a soft landing, but as we looked at, markets aren't always right on the initial reaction, but given where the yellow turned in July of 2019, we think that the first quarter of 2020, or this quarter that we're currently in, the dashboard is going to give us an indication whether or not we should get more defensive in our allocations or whether we should be taking risks because the market and this expansion will continue for the next couple of years. So with that, that's all my prepared remarks. Brian, I'll turn it back over to you.
Jeff, as always, just a great synopsis of things from your viewpoint and ClearBridge. Why don't we do this? I have another polling question, the final, number 3. We'll ask that. We'll wait for the response, and then we'll kick it into sort of the Q&A. Again, if you have a question, please enter it into the queue, but the good news is we have plenty to get started here. So the polling question number 3 is essentially, where do you believe, WTI crude oil will be at 12/31/2020, so just shy of the new year. Keep in mind we're currently at $59 per. So where do you believe? And there are, I believe, 5 choices for you to choose from. So why don't we transition over to Q&A? So while the questions are coming in, Jeff, you and I had a brief discussion on Friday, sort of prepping for this call, and I had said to you and our team that I found it very interesting when the news of the U.S. and Iran had hit, and historically my children have never really asked my wife or I anything about any of these things, these events that go on. But this time, 2 of my kids, one a 17-year-old asking about a draft, and a 12-year-old basically saying, "I'm nervous."
Not a fantasy draft, just for the record.
Not the fantasy draft, the draft. And so it became a sort of a table topic for the whole family, and we talked about a number of things, and U.S.-Iran was at the top of the list. And so there's a question for you right there. I'm asking, but we also got it from the audience here. Should equity investors be concerned with what we would call the U.S.-Iranian situation currently?
Well, great question, obviously topical. And last week, obviously, financial markets had sold off pretty aggressively. You saw oil spike up, but that has been reversed, and the markets are taking the news pretty well at this moment. And a key reason is because the U.S. is rationally assessing the situation and didn't make a knee-jerk move to retaliate. And Iran, their expectations and their attack was very clearly communicated. They had reached out to the Iraqi base prior before actually launching those missiles. There were no U.S. casualties. So I think that neither side really wants a war at this point, so it's something obviously to monitor. You certainly could see Iran take out some oil supplies like we saw with Saudi Arabia last year, but an all-out war I don't think is a very high probability. But even if Iranian crude exports went down and you did have a disruption in the energy market, they're only bringing in about 500 million barrels per day currently into the energy market, and that does have the opportunity to push energy prices higher, but I don't think it will move up substantially higher from here. But let's just say that maybe they close down the Strait of Hormuz, which a lot of oil travels through it, maybe the oil superhighway of the world, and you do see an oil disruption. The U.S. is going to be relatively insulated from that for 2 different reasons. The U.S. consumer actually is less sensitive to oil shocks than they traditionally had been. So if you think back to the 1970s, the average U.S. consumer spent about 8% of their disposable income on energy, whereas today it's closer to 2.4%. But also, the U.S. is the largest producer of oil in the world right now. We're officially a net exporter of petroleum, which is the first time in a very long time where that's the case. And if you do see higher energy prices, believe it or not, that may actually be a net boost to the U.S. economy rather than something that is maybe causing us a recession. So again, I think there's more smoke than fire here, but if you do see a disruption of oil markets, again, I think it actually would be a net beneficiary to the U.S. economy.
I think based on the responses, I think people concur with your comments, or at least 50%. So the answers are in. 50% of you voted that you thought that oil at the end of the year would be between 55 and 65 per, and then 25% at that 45 to 55 range, and then finally another 25% of you voting between the 65 to 75 range. No answers below 45 and nothing above 75, so kind of in that range you were talking about. So why don't we get to, again, number 2 here. So, so let's get to number 2. So if we go back to, I think it's slide 17, Jeff, one of our listeners asked specifically about this notion that corporations have been, the largest purchasers of equities. So the question is basically this: if companies continue buying back their own stock, could this affect the U.S. markets negatively?
If they continue to buy their own stock. No, I think there's a one-way street with buybacks, right? If you think about buybacks, they are very planned. They're very orchestrated. There's a lot of visibility there. It's indiscriminate buying, so it dampens down volatility, and it just pushes prices up. So I don't think that if they continue to buy equities, it's a bad thing for U.S. markets overall. And quite honestly, this is one of the reasons why the U.S. has outperformed Europe and Japan and other regions of the world. There's other reasons to it, but other regions of the world have favored dividends over share buybacks. You're starting to see that change over in Japan. Europe has still not embraced buybacks. But no, if corporations continue to buy back shares, that's going to be a net positive for equity markets.
Good to know. So continuing, I think specifically with slides, when we were talking, it wasn't just sort of the Iran situation, it was top of mind things like whether it's the geopolitical, specifically overseas, and certainly our own election, coming close. You also have this idea that trade deals are, whether they're imminent or certainly, the topic du jour that are going to affect markets negatively or positively. These are top of mind topics. And so, in your opinion, do you anticipate the ISM rewards moving to like a yellow or green with a China trade deal?
It's certainly the case. I think, obviously, if we clear up the Boeing situation, that could give a boost to ISM by 1 or 2 points. I actually think the ISM could surprise to the downside because of a resolution to the U.S.-China trade war, at least a phase 1 deal, believe it or not, because you've had inventory stocking up ahead of these tariffs, right? If you think about a company and you think that the price of your inputs are going to go higher, you're going to import more of that ahead of that potential tariff increase. And if you have an overstocking situation, that overstocking needs to be worked off, and that would actually probably suppress manufacturing PMI new orders rather than help it initially. So I don't think you're going to get that initial boost, even though we do have a phase 1 deal in place.
Okay, this is, I think, a relatively quick one. So based on some of your comments about the yield curve, the question is, shouldn't the yield curve be yellow?
So I would say, yes, the yield curve should be yellow in the sense that it is uninverted at this point. But as we looked at that slide previously, you can see that the uninversion told you nothing about whether or not you entered into a recession. Nope, we're going to keep it red for the remainder of this cycle, because when you had a sustained inversion going back to the 1960s, every single time you had a sustained inversion, and we like to think of it as sustained inversion as 3 months or longer, you've always had a recession, but that recession has ranged from anywhere from about 2 or 3 months all the way up to over a year. So once it goes red, we're going to keep it red. If we're over a year and a half out from this point and we haven't had a recession, that's something that we consider moving it back to yellow or green. But it's one of the only indicators that once it stays red, it will stay red for the rest of that cycle. The other indicator, of course, is going to be wage growth. The reason why wage growth will stay red when it turns red is usually the labor market will continue to be tight, and you'll see upward pressure on wages until you start to see layoffs. And when layoffs happen, you're on the doorstep of a recession. So the yield curve and wages are the only two that stay red for the entirety of the cycle once it goes.
So sticking with the themes of colors for a moment, in the dashboard's history, which yellow period is most similar to today?
That's a great question. We actually looked at this not too long ago, about a week ago, and the situation quite reminds us of 2007. I'm generally hoping for a soft landing here. I know this program is about the anatomy of a recession, but in 2007, when it turned yellow, it just really hung in that yellow range for a long period of time. You didn't see a clear inflection in the data, and then as you got to the third quarter of 2007, the data deteriorated very, very rapidly. And right now, we've been in a strong yellow signal since it turned back in July of 2019, and it's really been on the tail end, teetering on red for the last 4 or 5 months. So unfortunately, it's 2007 that this reminds me most of.
And just sticking with red for a second, how many indicators would need to be red, in your opinion, for a recession to begin?
So it depends on the individual indicator. Just as a reminder to everybody, the indicators aren't equally weighted. They're stack ranked anywhere from 4% of the dashboard up to 12% of the dashboard. That's going to be on a couple of different criteria. First off, how long is your data set? The longer the data set we have, the more faith we can have in that indicator being able to identify a recession. What's your hit rate? Did you get all 7 recessions right, or did you get 6 out of 7? How many false positives did you give us? If you give us a lot of false positives, you're probably not in this dashboard, to be perfectly honest. But lastly, most importantly, what's the consistency of when you turn red? When you turn red, is it always 3 months prior to a recession, or is it all over the place? Now, again, based on those 4 criteria, it's from 4% to 12% weighting in the dashboard. It really just depends on which indicators are red and which indicators are yellow and green. But maybe a good rule of thumb is that when you have 6 red, 2 or 3 yellow, and maybe 3 or 4 green, you're probably at a red signal.
So I think you touched on this, Jeff. I know you did, but maybe just a little deeper. Which indicators have you most concerned?
Yeah, and just to follow up on that last question, one more piece I forgot to mention is there is a difference between being solidly green and then green on the borderline of yellow, or yellow on the borderline of red as well. So that's also a consideration for the dashboard. Right now, which indicators have me the most concerned? I would actually say profit margins. I'm watching extremely closely. If you can see profit margins pick up from here, that would bode very well for the longevity of this cycle. Right now, you have a huge dispersion between S&P 500 operating margins and NIPA profit margins, with S&P 500 operating margins much higher than NIPA. Last time we saw a diversion this big, or a divergence this big, was 2000, and we all know how that divergence came back together, which was the S&P 500 coming down dramatically and us going into a recession. So I'm hoping to get a positive data point here at the end of January, and if we do, hopefully this revision will be positive this time around. The other one that I'm looking at is wage growth. The most recent wage growth print that we had came in below consensus expectations. The headline came in at 2.9%. If wage growth moves down lower, this would be a really good sign for profit margins. I was concerned at the middle part of last year that wage growth is moving higher and higher, and that would hurt corporate profitability. But if wage growth can stay in this high 2s, low 3s area, that gives us a very good opportunity for this to be an extended cycle. So wage growth and profit margins.
So Jeff, another question came in about corporate debt and your concerns. Does the level of corporate debt concern you?
No, the level of corporate debt does not concern me. And people like to look at corporate debt to GDP as a ratio to measure how much debt is in the system. I don't think that this is a very good representation. You're just comparing 2 random things. What I like to look at is net debt to profits ratio. This is not dissimilar to you going out and getting a mortgage, right? If you go out and get a mortgage, they're going to look at your assets, they're going to look at your income or your cash flows, if we were talking about businesses, and that would tell whether or not you can afford the mortgage that you're applying for. By using that metric, it's the same exact methodology, if you will, and by using that metric, corporate debt is right in line with what you've seen over the last 30 years. So corporations have the assets, they have the cash flow to be able to service that debt, so there shouldn't be any issues there. But What does have me concerned is at slide 48 here. You can see that the U.S. investment grade space is not your grandfather's investment grade space. You've seen a deterioration in credit quality since 1973, whereas in 1973, only 9% of credits were BBB. Today, 44% of credits are BBB. And when we go into the next downturn and the next recession, which unfortunately there will be a next recession, my concern is that you're going to have fallen angels that move from BBB, can get downgraded to BB, and you're going from a $6 trillion liquid investment grade market down to a $1.5 trillion less liquid market. And more importantly, institutional buyers won't be able to hold that paper. So when the situation happens, it's not only going to affect the company that becomes that fallen angel, but the markets will rightfully look for other potential fallen angels, and you have the ability or the possibility of contagion effects. I think this is a very good reason why you should have active managers for your bond or portfolio allocations, because they can be able to disseminate who is a potential falling angel and be able to sidestep some of the dislocations that's likely to happen in corporate debt markets.
So just going to the Fed for a sec, we actually got several questions on the repo market. The Fed's taking action here, quote unquote, propping up the repo market. Is this a potential warning sign?
It's not a potential warning sign. Obviously it was a warning sign back in 2007. You saw issues in the repo market, and that obviously led to the credit crunch that was ultimately the great financial crisis. It was a very isolated event in the repo market this time around, and you didn't see credit spreads blowing out. You didn't see credit default swaps for banks blowing out. Obviously the equity markets were very calm during that situation, and really what I like to look at is the OIS LIBOR spread, which is the unsecured market. You saw a small pickup in spreads there, but if this was truly a credit crisis, it was going to be something much more substantial. Now, obviously the Fed has been doing a balance sheet expansion at this point, and the question I always get is whether or not this is QE. The way I like to think of this is if you think about QE, I like to make a bucket analogy. So back in 2008, if you have a bucket full of liquidity, and that's how much liquidity the markets need or the economy needs, there's a hole blown in the side of the bucket in 2008. And what QE1 did is to bring that bucket up and fill it up completely. When you look at QE2 and QE3 and then on Operation Twist, that was meant to have liquidity pouring over the sides of the bucket to help financial markets, and it certainly did that. With this most recent incident with the repo markets, there was a hole in the side of the bucket. They obviously did a balance sheet expansion and brought that bucket up to being filled. But at this point, continuing to expand the balance sheet is having liquidity pouring over the sides of the bucket. So I think this time around, it is more than what's generally needed for the economy, and this is one of the reasons why financial markets are continuing to move higher because of higher Fed liquidity. And obviously the Fed is expecting to expand the balance sheet until the second quarter of this year. So you're going to continue to see the liquidity flowing in the near term.
Something that always comes up is just talk on the dollar. So any thoughts on where you see the dollar heading in 2020?
Yeah, I think the dollar has likely peaked and is going to be in a longer downward trend. One of the slides that we've been using is slide 39, is that you can see the dollar generally goes through a cycle from peak to peak of 15 years. We've had the belief that the dollar peaked out in 2016, and now we're going to be in a 4 to 5 year period where we're going to see dollar weakness. One of the reasons why we could see dollar weakness is slide 40, the twin deficits. Usually when you have a larger budget and trade deficit, 2 years later you'll see dollar weaknesses. And if we have a stronger or a smaller budget and trade deficit, 2 years later you have dollar strength. And you can see here that the deficits have been getting larger, which means the dollar should weaken over the next couple of years. And if you think about the entitlement programs, you look at the CBO estimations for Medicare, Medicaid, Social Security, the budget deficits are going to continue to get larger and larger, which should weigh on the U.S. dollar. Also, I'm very happy to see that the yuan has been strengthening. It's up 4% since September. It's up 2.7% since mid-December. And if the yuan is going to strengthen against the U.S. dollar, that should bode very well for other emerging market currencies together as well. So I do think that the dollar is probably going to be weaker going forward, and this should be good for international markets. You can see here on slide 34 that when you have a dollar bull market, that's usually very good for U.S. markets. When you have a dollar bear market, that's usually very good for international markets. And this coincides with what you see on slide 33. These long periods of U.S. outperformance or international outperformance, they usually coincide with dollar bull and dollar bear markets. So this is a long way of saying that I think international, from a risk-reward standpoint, looks attractive versus the U.S.
So going back to that top-of-mind comment a minute, maybe just your thoughts on the presidential election.
Yeah, so there's a long way to go to the presidential election, obviously. The one thing that I care about is the market's reaction to the presidential election. And if you look at slide 30, the markets don't start to handicap the outcome of a presidential election until about 6 weeks out from Election Day. The year heading into the election, the markets actually focus on the economy, and this looks at every U.S. election since 1936. There's been 20 instances. 18 out of 20 of those years, you saw a positive market return, so your hit rate for being positive was 90%, and the average return that you had in that year was 10%. So I know there's a lot of ink spilled about who's going to be the Democratic nominee, what's the potential policy implication, but it's way too early to be concerned about that, at least from a market perspective. The other thing that I'll mention is that there's been a lot of unmarket-friendly candidates during that time frame, and the market has shaken that off if you look at the averages in the hit rate. The other thing I'll say is that the consensus, if you look at the probabilities market, suggests a divided government. So even if you get a Democratic nominee who ultimately becomes president, or Trump goes for another cycle, if you look at the Senate, the Republicans have a 53-47 lead in the Senate. It's going to be very hard to have a Democratic majority there. And usually when you have a majority across the board, that's where you see some real changes. When you have gridlock, that's usually where you have a very stable political environment. You know, I've always said this, but the markets don't hate good news or bad news. It just hates uncertainty, and gridlock provides certainty. And that's what the highest probability outcome of the elections are going to be come November.
So as we come up on the hour here, we recognize that a lot of questions come in, and we really appreciate you sending them in. Look, if you didn't get yours answered today, obviously you can email the desk, your internal locally, or ask your external to reach out to Jeff and team for the answer. So look, in closing, as you think about asset allocation, or you're rethinking, your current asset allocation models or investment choices, whether you believe that we are in a slowdown or the beginnings of a recession, we are likely getting to the late stage or the end of this economic cycle. And this could obviously be a great opportunity, not only for just a phone call to a client or a portfolio review, but also to potentially upgrade your portfolios. For us, we believe that having a high quality bias in your portfolio could be, quite an attribute favored by investors. And that goes until, let's call it, the final bell rings on this expansion. So at ClearBridge, in particular, we have two potential high-quality options to look at: large cap growth, and another one is our dividend strategy, which a lot of you do invest in. Both portfolios with that high-quality bias, but also strong downside capture ratios, which we know come in handy, especially if there is uncertainty going forward, and with a defensive slant. So for more info on these, you can obviously reach out to the desk or your local wholesaler. So finally, look, going back to my opening, it is individuals like you that continue to inform us through feedback on how we're doing. And so to that end, it's been amazing for all of us here at LEG and at ClearBridge when we think about the creativity that we've learned through discussions with each of you, and the way and showing us how you've demonstrated how you're integrating AUR into your businesses, whether you're using the presentation holistically in all its slides or only utilizing certain slides. We are hearing that AUR is definitely being used out in the field. And this could be in your team discussions if you're part of a team. It could be, for personal use. It can be when tweaking allocations or making outright allocation changes. And certainly the general reviews you have with clients, or phone calls, the quarterly reviews. And if you're just simply looking for salient bullets that are timely, that you can use on a daily basis to help, again, make decisions or validate a decision you're looking to make. So it's really great to hear that Anatomy of a Recession continues to have an impact. So with that, first of all, I want to thank Jeff Schulze. Great job today, as always. Very informative. I know no one would ever dial in for a 2 to 3 hour call, but sometimes I feel like it's just what we need. We don't get to every slide. We don't get to every question, but for the hour that we have you, it's valuable, and we really appreciate it. Also to our partner firms that allow us to do this WebEx, this call, and then certainly to all of you that have dialed in. So with that, thanks again. We look forward to talking to you next quarter. So have a happy new year, and may the markets be with you.